Trade credit insurance plays a pivotal role in safeguarding businesses against potential financial fallout from non-payment by customers. However, in today's rapidly evolving global economy, it's imperative to stay abreast of the latest developments and options in this field. And today, it's a real pleasure for me to give you some exciting news on a very recent development in the trade credit insurance space. I'm honored to talk to Roan Stoop, co-founder and MD of Credit Circuit, an insurtech and fintech platform in the trade credit insurance and receivable financing space. Gareth Joubert, MD Hollard Trace Credit, and Devan Kerr, MD of Premium Finance Partners, about the launch of Credit Circuit. It's not every day that I have three people on an interview, so I'm going to enjoy this one. So Gareth, I think let's start with you. For in case we have someone listening to the interview who needs to know a little bit more about trade credit insurance, very briefly, what is trade credit insurance?
Thanks, Rianet. Thank you for the opportunity. It's a pleasure to be here. I think if we could just take a little step back and first understand what a credit transaction is that would be eligible under a trade credit product, and then I'll get into the insurance side. Effectively, an eligible transaction would be where a good is delivered or a service is rendered, and there's a future dated payment. So as long as the good is delivered or the service is rendered and then the payment happens, that's what's considered a credit transaction. And the insurance is then the cover that the seller or the service renderer can take out in the event that their client is unable to pay them.
Okay. What's the biggest risk in this space?
I mean, that's an open-ended question.
Yeah.
I really say that probably the hardest part about this is that at the end of the day, the client or the person that's needing this type of cover is not the one that's requesting the credit transaction. It's often the buyer that is saying, I'm only going to pay you 30 days from statement, or if you're dealing with some of the big corporates out there, you're at 90 days from statement. And the business doesn't actually have the cash flow to be able to withstand that credit term. So the difficulty again is that there's a mismatch between the cash flow that's available in the business and then what the clients are demanding in terms of when they're going to be paying for those services or for those goods. And certainly another aspect that's on the rise lately is fraud. Fraud is on the up. And certainly we found that when we launched in 2016, we used to get one fraudulent application within every 4,000 reviews that we did. We're now at one in less than 1,000 reviews. So we're crossing fraud on virtually a daily basis now. And I'd say that's the problem, right? When you're dealing with cash, it's quite easy because you get the cash in your hand when you let go of the good. Whereas when you're dealing on credit, you're at the whim or the discretion of the guy who's going to pay you. And if he decides not to pay you, you're almost in the donations game. If he's fraudulent, same pace, you're just giving your stuff away for free.
100%. I think this might be an interview for another day because I've got quite a lot of questions, but I'm sure business have picked up quite a lot for you in the last few years because times are tough, right? So yeah. But let's have that conversation on another day. Can you touch on the innovation we've seen in the Hollard trade credit product and why you believe it's a fairly unique product compared to what we currently have in the market?
Thank you, Rianet. I mean, this is certainly a personal, a matter that's really close to my heart. Is when we launched the business in 2016, we spent a significant amount of time understanding what the landscape looked like, understanding where the potential pitfalls in the economy were, and then what risk mitigants were available for clients. And what we found in our research is that the product that exists, the trade credit product that exists in the market is largely, call it a European-based model, where it's less about cash flow and more about almost debt security in the long term, which is fine if you're operating in an economy where everybody has money and when interest rates are down at 1%, maybe even 2%. Right? So it doesn't really matter because the time it takes for a client to pay you doesn't depreciate the capital value of the good. Whereas if you look closer to South Africa, if you're waiting 6 months before you're getting paid, we calculate that the cost of credit is somewhere at about 2% a month if you're funding that through an overdraft. So you take any balance sheet that you've seen or any business that you've seen and you wipe out 12%, right? That's the 6 months at 2% a month off their bottom line. There are very few businesses that are then making a profit. And no businesses are in business to not make a profit, unless obviously they're specifically deemed a not-for-profit business. So that we found was our greatest value add, was being able to pay the clients as quickly as possible so that they can be in the best possible cash flow position. We then found out as well, coming to a holistic credit management solution, that really the operational credit management in the business is not really up to scratch. And we assist the clients, we handhold them through the process of understanding who they're dealing with, how they're dealing with them, so that even if we don't grant the cover, that clients at least know that they've got tangible security or tangible contracts that they can take to court to enforce some kind of a judgment so that payment can come. Because like I said, without that, you're effectively in the donations game. And then one final aspect that we've included was the ability to select who you want cover on. You're not forced to insure your entire debtors book. You can insure from one transaction all the way through to your whole book. The client should be the one deciding what cover they want. And we put that power in the hands of our policy holders, which lends itself quite nicely if you look at call it the confirmation of debt process, which makes us pay claims sooner, and the selection of who you want to insure. It lends itself quite nicely into what Roan has managed to build under the credit circuit model.
I see and hear a lot about education when you're dealing with clients. I assume that's quite a big part of the role that you have to play when you start dealing with, especially new clients, right? Education, but that's our industry.
Yeah, absolutely. And I think testimony to what we're trying to achieve is that about 60% of our new customers that join our portfolio have never had trade credit insurance before. And that leads itself to a lot of complexity when it comes to training and understanding how it should work. But again, we hold their hand through that entire process so that they are comfortable and that they're going to get paid, because that's the only reason why they're taking out the policy at the end of the day.
And on a sideline, I assume the broker plays quite an important role in this process, right?
Yeah, absolutely. So every single one of our policies is 100% intermediated with brokers. The broker market in the trade credit space is an interesting one in that it's largely controlled by specialist trade credit brokers. But Hollard made a position when we launched to actually open it up to all brokers that are capable and obviously have the product training to be able to understand the product that they're selling. But we find that we shouldn't be hamstrung by a certain channel and rather be able to access the entire market, because as you mentioned earlier, the economy is not in the best space possible.
Yeah.
And the more protection, the more security that we can give clients, obviously the better for the economy.
Right. Roan, let's move over to you. You guys saw a gap and launched an insurtech fintech. Please take me through your offering and also share how the puzzle fits in with Hollard and premium finance partners, which we will talk later to. For me, it's just a brilliant example of collaboration in the industry, and we so often talk about the fact that we need to collaborate more. So talk to me.
Thank you very much, Rianet, and thanks for the opportunity to have this interview. So yes, we saw a gap in the market to bring the trade credit insurer and the receivable financiers and the clients together in a more efficient manner. And we believe that we would be able to bring down costs and bring more capacity to a larger scope of clients. So essentially what the product is if you've got a Hollard trade credit policy in place with Hollard, or we put one in place for you, that policy can either cover a single debtor, a number of debtors, or your whole book. So once that is in place, you can then access the cash that is tied up in an invoice before the invoice becomes due. So that effectively becomes a working capital solution. So instead of using an overdraft or a loan, which is a debt on your balance sheet, you're able to access working capital on a non-recourse basis. So what this means is that the financier doesn't look to the client's balance sheet and doesn't take collateral. And so therefore we can help a larger scope of clients because we're looking at their debtors book, which is then secured by Hollard. Our funders are fully covered by Hollard, and therefore they're able to give better capacity, better rates. And the product is very seamless for Hollard's policyholders. So they can choose which debtors they want to fund, and it doesn't affect their operations with their debtors in any event. So it's very seamless. It's also a multi-funder platform, and we do that so that we bring competitive forces into the space. And Premium Finance Partners have put together an SPV, which is now our largest institutional funder on the platform. The great thing about our product is also that we can assist clients that have an existing session on their debtors book. So we've developed a very innovative legal framework to protect our funders so that they can fund debtors where there is already a session on the book by a financier. So the reason we wanted to do this is because we want to bring more competitive forces to the financing space, because currently it's kind of an all or nothing approach. If you want to change your financier, you have to move your whole book over to another client. So you can't get to try out the product on a small scale with a new provider to actually test out how good is their service, how reliable are they, and do I want to go with them? So with our product, you can take one debtor, test the product out, and hopefully we'll show you what a great product it is, and then you can bring more of your debtors on board. So it is very crucial for us to bring that innovation, that legal framework, and build that, and we're quite proud of that. So that's the product in a nutshell. But just to touch on the distribution, we obviously distribute through Hollard's brokers. As Gareth has mentioned, it's open to all commercial insurance brokers that have a Hollard agreement and have the training. And we also offer a substantial commission on that leg of the product of our fee, and that's on an ongoing basis. So what you can find is typically if a broker distributes the Hollard product in combination with the credit circuit endorsement, they can almost double the commission that they get on that product. So it allows brokers to earn by distributing the financing component as well. So that's also a good thing to mention.
Yeah, I think it is very relevant. I didn't have it in my list of questions, but that's always a crucial part of a broker's questions is the commission part, which is fair. You've mentioned a problem that you've addressed. My next question was, what is the biggest problem you have solved with this offering? Is it that, or is there something else you have solved?
Yeah, so I think there's two major problems that I think we've solved or helped solve. So the first one is bringing the funder on board and the insurer on board so that we can have 100% cover for the funder, as I mentioned earlier, while at the same time making very seamless for the funder and the policyholder or the client. And so there was a lot of structuring in terms of how to make that possible legal in terms of the finance and the insurance. So I won't go into the detail, but that was very important for us to make that work. And then the second biggest thing, as I mentioned, was the legal framework around the being able to fund where there is a session. And I'd like to just speak a bit more about that because it's something we're quite excited about. So what we've developed is we currently, just to give you a bit of background, globally, promissory notes, which is a very powerful instrument in trade finance, cannot be digitized. There's only 3 territories globally that now have digitized promissory notes, meaning you can sign a promissory note electronically, and that is the US, the UK, and Singapore. More jurisdictions are moving that way, but currently it's a question of bringing the legislation in place and also advancing the technology. So we didn't want to wait for that legislation and technology to be rolled out in South Africa. So we did a lot of work with a top law firm and with Hollard Legal to develop a implementation for electronic promissory note in South Africa using existing legislation. Even though the legislation doesn't explicitly support it, we found a way to create that. In our technology stack, we also use existing technology that clients are comfortable with for debtors to sign a confirmation of debt. So we use Adobe Sign. So we've also used existing well-known technology stack as opposed to developing third-party technologies that clients are not comfortable. And as I mentioned earlier, we're very excited about this because it really brings more competitive forces for clients to try out a product on a small scale, which I think is very important for the consumer at the end of the day. So yeah, those are the 2 problems that we feel we've solved, which are quite significant.
It's all very exciting. Wow. I assume it is a market first, Roan.
Yes, on the electronic promissory notes, as far as we can tell, that is a market first in South Africa. And the way we've structured our multi-funder insured receivables platform. We also believe it's a first in South Africa.
Devan, your turn. Why did you partner with Hollard and Credit Circuit?
Rianet, I think as a starting point, when we look at any investment or partnership, it's always about the people. And I think we spent a lot of time with Gareth and Roan, kind of understanding their model. And it became pretty clear to us from the beginning that we kind of liked their energy, we liked their direction, and more importantly, we knew they were the right guys who could kind of execute on their vision. And that was something that we kind of felt resonated with our business, and I guess with people that we really wanted to get behind. And then I think outside of the personal element, I think from a business and a corporate perspective, we realized that kind of having the three parties together is something that would create a very formidable force into the market. If you look at Credit Circuit, it's a nimble fintech driven business. You've got Hollard that has a great brand in the market, and also more importantly, the capacity and balance sheet to take on a significant amount of risk. And then we thought through, kind of combining that with our access to capital and our facilities would mean that kind of from a product perspective, we'd really be able to take advantage of the immense opportunity that Credit Circuit has.
It's very exciting, this collaboration, and I agree with you that it's a formidable force. Times are tough, Devan. Do you believe the need for a product like this is now more important than ever?
I think at a holistic level, and I know Roan and Gareth will agree here, but accounts receivable financing, whether it's catered as invoice discounting or factoring or supply chain finance, we believe is very underutilized in the country. And I think it's, it comes from the bad connotations that were created in the past, but we think that it's definitely a funding product that should be used a lot more by corporates, by commercial companies, by SMEs. And I think with what Credit Circuit is bringing to the market and a little nuanced view to how they manage it, and how they process their transactions, it's going to really increase the uptake that we think of accounts receivable funding. I think coupled with that is where I think kind of Credit Circuit is very unique, is that as far as I know, they're the first real party that offers proper risk transfer to their users, which is something that's well needed in the market. And because of their model and their construct of how they put everything together, they significantly are going to undercut from a pricing perspective the rest of the market. And I think the combination of giving clients proper risk transfer at a rate that is significantly lower than what you've seen in the market is something that I think will offer a lot of value to corporates across the country, but more importantly to corporates or commercial companies that are a little bit under pressure given the prevailing economic times.
I think you guys have all touched on a few very, very relevant things that brokers would want to need to know when looking at this product and before going to clients. So, Devan, please explain the SPV that you have put together to fund receivables on Credit Circuit and what your long-term model is around this.
Yeah, so Rianet, I think when we've engaged with Credit Circuit and seeing the immense amount of demand that's coming through for the product as well as the pipeline, I think from the get-go we recognized that raising a significant amount of capital in the long term is absolutely vital to the success of the platform. And the best way to structure that from a funding perspective, without getting into too much of the details, really to do it through an SPV. So what we've done is we've put forward an SPV structure. It's syndicated, which means that various funders can come into that SPV at various levels of risk. But ultimately what it does is it will provide the end user customer with one funding line that is competitive, that is security efficient, which means that we can scale it in an efficient manner given the security stack that's available. But more importantly is I think it provides the end customer with one rate and one term that is needed for their facility rather than having various funders come through. So it was really reaction, I guess, to making sure that we can facilitate the ongoing need and capital demand of Credit Circuit and its customers into the long term.
Gareth, Devan, Roan, thank you for your time. We definitely do need more time to talk about this, but in the interest of time, I think it's important that we refer the audience to the Credit Circuit website, where you touch on quite a lot of the important questions people might have, specifically the brokers. So under the Q&A section, I went to delve a little bit there, and all the questions are answered there. But thank you for your time. It was most certainly a pleasure for me. I learned something today. I really enjoyed the chat. We will also be doing a profile in the FAnews magazine on this, so people can go and read also a little bit more about this. But thank you for your time, and all the best with the launch and everything going forward.
Thanks, Rianet.
Thank you. Thanks for that.
That's
Thanks, guys.
Rianet Whitehead, editor, FAnews, signing off.